I do have joining me for that Patrick Buthelezi. He's an economist at Sanlam Investments, Professor Patrick Bond from the University of Johannesburg's Department of Sociology, as well as Annabel Bishop. She's a chief economist at Investec. To all of you, good afternoon, and thanks so much for your time. Annabel, I am a believer, firm one of ladies first. I'm going to start with you. I mean, going into this meeting, we know that the call was pretty close. I read your note, although the market had discounted 50 basis points. It had also kind of discounted 75 basis points. So a close call, but in your view, was this the right one?
Yes, hi, Fifi. Look, I think, it's a very difficult environment we're going into. Globally, we're seeing high interest rates. And of course, in South Africa, we've already started to see high interest rates last year in November. And of course, the financial markets widely expecting the Reserve Bank to hike interest rates today, as you said. And of course, not wanting to disappoint the markets, but also, of course, as well, very clearly concerned about inflation. I think, Fifi, the way I read the decision today is very much the Reserve Bank looking to front load to put through as many and as much interest rate hikes as possible, because of course we find ourselves at risk of a global recession next year, and of course of slowing global demand, and that of course impacts South Africa, creates weaker economic activity in South Africa as well. For us, we have an interesting difference in our inflation dynamic compared to what's happening globally, and that most of the pressures coming are from the supply side. And of course, if you look at countries like the United States, they also have demand side pressures as well. So I think, the Reserve Bank today is seeking to perhaps put a cap on inflation expectations, and of course, worrying about a wage price spiral, as opposed to any major evidence coming through of demand side pressures at the moment.
All right. And well, you've helped me understand a little bit better why they did what they did, but you haven't answered my question. Was this the right call to make in our context as South Africa?
Look, I suppose, if you want to front load your interest rate hikes and obviously try and put a cap on inflation expectations, then, from that perspective, it was the right call to make. I think it's difficult for us to avoid an interest rate hike because the United States is hiking quite rapidly. And if we look back historically, when we see the differential between South African and United States interest rates narrowing quite significantly, we do get very pronounced rand weakness. And of course, that's one of the reasons why we have seen the rand weaken recently. Also, of course, as well, and we're talking against the dollar here, also, of course, as well, US dollar strength from high levels of global risk aversion. So, I think it is difficult when you've got a weak economy and households battling. But of course, you balance that against the Reserve Bank's concern of inflation, particularly high inflation. Of course, high inflation is very detrimental to the economy, to the poor, to investment, to business. And of course, the Reserve Bank seeking, to fulfill its mandate of controlling inflation.
All right. Talking about the rand, we're seeing it reacting positively, I assume, to what has just been announced by the bank in terms of that 75 basis point high, currently at 17.09 to the 17.06 to the dollar, from just above 17.10 coming into this meeting, and above 17.20 at lunchtime. Patrick, or Professor Bond, to me, I suppose, the same question to you, because Annabel's really explained the fact that clearly our governor and the SARB is pretty worried about inflation. And I'm just wondering if you think that CPI report that did come out yesterday practically had put the writing on the wall in terms of the 75 basis point in interest rate announcement that we've heard today. And the same question to you, sir, whether you think that this was the right call to make.
Well, yeah, thanks very much for having me. I don't think it is. I'll pick up two of Annabel's very clear points. Number one, this is not inflation that's coming from wages or from a demand side. In other words, it's not the excessive exuberance and excessive money in the economy. It's coming from external shocks, and with the exception of Eskom, which is, just out of control with its own price hikes. But, those could be controlled. One could do quite a bit to rejig the way Eskom prices. We could do a lot to rejig the way oil prices get transferred, because these are administered prices. And instead, this is, I think, an ideological reflection. And the other point Annabel said, just remember some history. 2008, it's kind of similar in feel. In other words, a sort of rising interest rate as the world overheats, or has, in this case, a more stagflationary environment. But don't forget, when then Reserve Bank Governor Tito Mboweni raised the interest rate quite dramatically 14 years ago. It then coincided with the world financial crisis, and he had to immediately lower them. He went way too far, and we went into massive consumer debt. And I kind of feel, even in its small steps in these same directions, this could be the danger, especially if world financial chaos looms, as many are fearing, given that the war won't end soon. And I would add one other thing. I think to call this an inflationary oil environment when the price of Brent crude went from 120 plus in May, now down to 106 today, but it was below 100. That's also a misreading by Governor Kganyago. We will probably see a deflation across the commodities, including our own exports of coal, of iron ore, of gold, of platinum. And I think in all these respects, by kind of punishing consumers, putting the debtors in the country, which are already hurting very greatly, and therefore stifling the economy, this is exactly the wrong move at the wrong time. And instead, he should have tightened exchange controls to have more scope for lowering interest rates at this critical period, where so many people are so angry and frustrated, unemployment close to 50%. We are facing such social turmoil that he's now adding fuel to that fire.
All right. And I was going to ask you a follow-up, Sir Professor Bond, in the fact that you're alluding to the fact that the governor went too far here by increasing so strongly, that what should he have done? And I thought that you were going to tell me something about a 50 basis point increase, but you just indicated that you think that he should have actually lowered interest rates at this stage. Is that the case? And if so, by how much?
Well, yes, I won't toss a number at you, but just look at the last quarterly bulletin from the Reserve Bank. It came out last month. It shows that all of those indicators at the roots of the economy, including gross fixed investment, and businessmen need lower interest rates to have the incentive to invest. So a lower interest rate, and if you put on tighter exchange controls, you might know that in February, the finance minister, Godongwana, had loosened them, especially for, the likes of Sanlam and Investec to take money abroad, pension funds, institutional investors. And they can now, instead of keeping 70% in the country, only 50% of their assets need to be South African based. So that's, several trillion rand that, is liable to run. And I think tighter exchange controls would have allowed for lower interest rates today. And instead, we really have a dogmatic, let me call it neoliberal or kind of pro-Western ideology, which is follow the U.S. Federal Reserve. I worked at the U.S. Federal Reserve a couple of years, and I just don't think that's the right way to treat an economy with the problems that we have.
All right, Patrick, a punishment on consumers, according to Professor Bond, if the bank was looking to front-load interest rates, this was the right call to make, according to Annabel. What are your sentiments? And I'm just wondering if we should have, known that this was going to happen, just given the fact that about minutes before the governor had announced his decision, the European Central Bank governor announced hers, and she also put her foot on the accelerator a lot faster than people had initially expected. So your take on whether this was the right call to make for South Africa's context?
Yeah, this is a very interesting one, given our context. If you look at what has been happening globally, most central banks have been deciding to hike relatively more aggressively. And in terms of inflation, locally, we have seen inflation surprising on the upside. Even yesterday's inflation print was higher than what was expected. So on the inflation front, we do have inflation problem. Even if you look at the Reserve Bank inflation forecast, they've been revising inflation forecast higher, and it's currently way above that 4.5%. They want inflation to be at. But at the same time, we have a growth problem. The bank highlighted that in the second quarter, the economy will likely decline. And also in the medium term, they revised inflation GDP forecast, especially for next year, I think just around 1.3% or so. and thereafter. So we have a very low growth environment, but at the same time, we have inflation environment. So we would have liked to see slightly lower than 75 basis points, but obviously they are choosing to fight inflation very strongly. And if you're looking at the QPM model, what it projects, especially for the end of the year, I mean this year, I mean it projects that the repo rate should be at around 5.6%, and already the repo rate is at 5.5%, which clearly shows that the SARB is moving very aggressively to try and fight inflation, which is very high currently.
I'm wondering if now that model needs to be changed. Just looking at what the governor did say, I mean, the QPM model, it remains a guide, but it does change from meeting to meeting in response to new data and risks. And so, Patrick, you've alluded to you're expecting not as big as an interest rate hike this time around. So I imagine you were on camp 50 basis points.
Yeah, no. I mean, we are aware of the risks given inflation outcome and given what is happening globally, but we're hoping for something less given the risk to growth, especially in the second quarter. The numbers that have been coming through have been showing that economy is weakened very significantly in the second quarter.
Yeah, except some of the governors at the bank were actually expecting or hoping for more. The governor did say that on the table was a discussion of 100 basis points. It's so funny, this on the table statements. I'm wondering where he's getting it from, perhaps following what the international media is talking about, things being on the table. But Patrick, what do you make of that, of the fact that other governors were thinking that 100 basis points is actually what this economy needed? And why do you think that that's not the case?
Yeah, 100 basis points. That's very steep. I understand the concerns about the currency and the fact that the Fed raised rate by 75 basis points. So interest rate differentials. They seem to wish to prefer very narrow interest rate differentials, but 100 basis points, I think it could have been more steep for the economy. Things are very tough. Inflation is very high, it's squeezing the consumer. And we have seen also just the lower end. Inflation is more than 9% for an example. So the consumer still needs some support here.
All right. Annabel, so you listen to some of the commentators, particularly focus on the US market, and there's a whole lot of concerns around a recession that is induced by interest rate increases that are too aggressive. So essentially, there's been commentary made around the fact that the Fed could hike the US economy into a recession. And I'd like to understand how that pertains to a South African context, because Patrick has said that clearly this 75 basis point increase means that the bank is choosing to fight inflation a lot harder, right? So by virtue at the expense of growth. And so what does this do, the cumulative 5 interest rate hikes that we've had so far, and what we're still expecting in the future, what does that do to growth? Is our SARB also possibly going to hike us into a recession, I suppose, is the question?
Yeah, I suppose it's a tough question. Look, I think what we find ourselves in South Africa is that we are quite clearly following the path of what global monetary policy is doing. We are finding ourselves in a situation where it's almost the done thing to hike very significantly, very quickly, and very suddenly because of the very high rates of inflation. Look, I think it's important to note, and the Reserve Bank, of course, themselves note this as well, that it takes 6 to 24 months before the effect of an interest rate hike to impact inflation, and particularly 12 to 18 months, the Reserve Bank says. But also quite interestingly as well, when you hike interest rates, they don't have an immediate effect necessarily on GDP growth. It's actually lagged by a few quarters. So what I'm really saying is this very large 75 basis point hike we've had today, and of course, 50 basis points previously. In fact, all the cumulative interest rate hike increase that we've had in our current upward interest rate cycle will have a building effect through the rest of this year, even if we don't have any further hikes, and certainly over next year as well. And that's the same thing for the United States. You know, just your point you made about the United States being potentially willing to hike rates until the economy falls into recession. You know, I have read a number of commentators there saying that they're very worried about the tightness of the labor market, the great demand for workers, and insufficient workers, and of course that in itself, the Jerome Powell, the governor of the Federal Reserve Bank, indicating that they might need to weaken the labor market quite significantly to bring inflation down, because obviously wages being offered go up when they cannot attract people they need for the position. So it's a very different environment to South Africa. You know, we've got a very high unemployment rate. We've got huge surplus of workers who'd like to work, but obviously, cannot find jobs. And of course, we find ourselves in a situation where our inflation rate is not that high. Now, I think the Reserve Bank perhaps is focusing perhaps more narrowly than that. They're not looking at this large picture that I've tried to outline for you. And I think, that given that other central banks around the world are rapidly front-loading their interest rates, perhaps they're looking to do so as well. I don't think the Reserve Bank would intend to hike interest rates to push the South African economy into the recession, but I think, that could be an unintended consequence if, the global economy does fall into recession. Of course, if also as well, we do see another 75 basis point hike coming through from the Reserve Bank in September, let's say, and a further 50 in November, because that's what the FRA curves were indicating this morning. I haven't had a chance to look at it since the meeting. But of course, that's the risk. If you look at the Reserve Bank's QPM model, also, substantial interest rate hikes going forwards, I would really say that, while the economy looks like it's recovered from COVID-19, from a GDP overall perspective, there are many sectors, there are many individuals, there are many households who haven't. We have very high debt levels. And I think, the big risk of rapidly hiking interest rates is that, given that our interest rates are so low, if you can see what I mean at the moment, if your interest rate's at 5% and you take it to 10%, that's a smaller jump by moving by 5% than if your interest rate was at 2% and you took it to 7%. So I'm saying it has a greater effect. And of course, we're going into a very rapid interest rate period now. So, I am worried about the economic outlook. And I think the risk, particularly given load shedding and many other factors, I think, that we know about, the risk is that our economy might slow more than anticipated. And of course, these big interest rate hikes would have an effect on it.
Because the governor did note his concerns around the potential pressures from wage inflation. We have seen the negotiations going on right now. A lot of workers are reacting to the fact that we are in this really difficult cost of living environment, as it were, Annabel, and therefore there are risks to the upside that wage inflation starts ticking higher. But I'm just looking at this and I'm like, okay, so we're taking the step right now to arrest inflation and potentially even the risks of wage inflation. But now you've increased interest rates by a lot more, and that in itself is also applying pressures to the cost of living. And therefore, what does that do to future wage discussions that are coming up, and by virtue the wage settlements that we could be seeing? I mean, what's your take there? And I mean, could we even see higher than the 7% that Eskom got at other key government or public sector institutions just as a result of this decision?
Yes, I think you've outlined it well. Look, I think we find ourselves in a situation where our current Reserve Bank team, the monetary policy team, is extremely hawkish. And of course, we saw that over the past few years where they forced CPI inflation down to 4.5%. And of course, that was partly at the expense of economic growth. And we're talking before COVID now. And, prior to that, when we saw under Jill Marcus's Reserve Bank, there was a more even balance towards inflation and GDP growth. You're talking about the Reserve Bank worrying about a wage price spiral. Of course, people expecting higher inflation and even higher inflation, of course, then demanding higher and higher wages. And you bring up, the 7%, which obviously now, given that inflation is at 7.4%, some may argue, is already too low. But of course, that's just 1 month's reading, not the reading for the entire year. So, we do think that there'll be further upwards pressure on wages. I think it's a very difficult environment because I had a look today at the inflation figures for the CPI for transport costs were up 36% year on year, and actually fuel costs up 45% year on year. Now that doesn't touch sides with the 7% wage settlement. So I think there's certainly the risk of further upwards pressure there, as you mentioned, Fifi. And I think overall, the bottom line is that South Africa is in a tough economic environment, and of course will get tougher now that we've seen higher interest rates, and of course, the propensity for the Reserve Bank perhaps to hike even substantially more this year, given the forecast that it put out.
Mm-hmm. Professor Bond, I think that just before we lost the governor due to some of the technical glitches that we experienced this time around, I mean, the governor was saying that, he believes that they've taken the appropriate steps for households in the main, just perhaps shielding them from the inflationary pressures, potentially once the interest rate increases begin to kick in. And I'd like your view, sir, on I know that you don't agree that the step that the governor did take was appropriate, but I'd like your understanding of what you think that this will do to households.
Well, I do think the governor and the whole monetary policy committee is out of step with the society. I suspect they're not debtors. I mean, I think they probably have fairly good net financial assets, and having higher interest rates serves their interests and their constituents. After all, commercial banks, own the Reserve Bank. And I think this is the basic dilemma in a country with close to 50% inflation, where just a year ago we had riots and looting that reflected a powder keg exploding. And when you have even the strongest union going to very extreme measures to get the ESCOM management to give them just a 7% increase, and that's now, as you say, below the inflation rate, I don't think any other unions have the capacity to do a sort of wage push. And I also don't think we see in the foreseeable future, aside from ESCOM, any domestic pressures on inflation. These are still imported. It's absolutely insane, this kind of, let me call it by what I think it should be called, sadomonetarism, right? A sort of sadomasochistic economic policy that could well lead to, massive defaults as poor people lose jobs, as workers can't service debts, as the machinistas go crazy. And this is the sort of recipe for serious social unrest. It was, after all, a debt crisis in Sri Lanka, fiscal austerity, rising interest rates that led last weekend to a revolution there. Is this what Lesego Kganyago is wanting? I think he's preparing the ground for it.
That's a scary warning there, Prof. Bond. And I mean, how viable do you see that scenario being? I mean, essentially you're saying that we could be in for round 2 of what we witnessed last year during July.
Yeah, well, frankly, I mean, the whole last, say, dozen years since Tunisia had a very similar set of sort of IMF-mandated austerity and higher value-added tax, lower corporate taxes. We've seen across this continent and across the world what a conservative think tank in Washington, the Center for Strategic and International Studies, calls the age of mass protest. And these little, you never know what will be the spark. Would it be Jacob Zuma being put in jail, or some little spark may set it off? But, the dilemma is that you did want to do something from the Reserve Bank, it wouldn't really be monetary policy committee. Certainly they should be lowering interest rates to avoid this sort of pressure on ordinary people. Instead, I think what the Reserve Bank should do is look really hard in the mirror and ask, why are we about to be grey listed by the Financial Action Task Force, right? An IMF and Bank for International Settlements body. This is, the world financial establishment, for having a really terrible record of stopping massive illicit financial flows, letting the rich people in this country, in the most unequal country in the world, take all their money out of the country. Their currency collapses. We've gone from 14 to 17 rand to the dollar this year, and the Reserve Bank seems to be doing nothing to stop that sort of rot. Even the Director General of Treasury, Ishmael Mumamiat, told 702 Radio last week that they have really serious problems with stopping illicit finance. I mean, even our own president was implicated in MTN and Lonmin and Shanduka in these tax haven gimmicks. So I do think we've really got to get to grips with much bigger questions as to whether Lesego Kganyago really should stay in a job where he's clearly so biased, ready to put up interest rates to fuel misery and despair when the society's right on the edge.
Right. So to the governor's defense as well, I mean, what happens to the rand is important, and protecting that interest rate differential benefit it's important, because I mean a weak rand has got its own ways of filtering into higher inflation further down the track. And Patrick, perhaps just give us the market's perspective. I mean,
well,
this
just
is
very
good for
quickly,
markets.
that's why the tighter exchange controls would be the critical way to protect the rand, not a higher interest rate. Sorry.
All right. I hear your point, but just a higher interest rate, what it does do right now is it does make South African assets pretty attractive, and it guarantees some of the inflows that we have been seeing, although a lot of outflows as well as a result of global monetary tightening that we've seen, the flocking into the dollar for safety and all other safer assets outside of emerging markets, as it were. But Patrick Buthelezi, I just noted that we've got two Patricks on the panel. Patrick Buthelezi, sir. Just this is good for markets, right? And do you, I mean, continue to expect to see a few more flows coming in and choosing South Africa as a place to invest, particularly with the 10-year bond now offering 11% in yield?
Yeah, I mean, interest rate differentials, South Africa is relatively high compared to developed economies.
How many last questions do you have?
I think that is also one of the reasons why we may have moved relatively more aggressive, just to try and protect the differentials, to protect capital inflows. But I must say, it is difficult for the Reserve Bank, because the tool they have
That's exactly what we
at their
said.
disposal is interest rates. And as my panelists have indicated very clearly, that inflation, unfortunately, is not driven by demand, it's supply. And what they can do just to bring the balance between demand and supply is to hike rates and reduce demand and to increase supply. So this also speaks to the importance of implementing a structural reform. And they have a mandate, and their mandate is to keep inflation within 3 to 6%, and inflation is currently above that mandate. And also what is more of a concern for them is that expectations also are drifting higher. And if they allow expectations to remain way above where they would feel comfortable, then it will become difficult to bring inflation down in the future.
All right. Just wrapping up the conversation right now, I feel I'm pretty biased here, because I like the tone in this entire panel. I'm not too sure that 50 basis points was warranted in a country like South Africa, where, yes, inflation is high and there's a risk of it going out of control, but it's not as elevated as we do see in other parts of the world. What is elevated in this country in particular is the level of unemployment at record levels. What is elevated in this country is the level of poverty, also at frightening levels. And I just wonder why 75 basis points was justified. But that's not the point. And I have declared my bias. It's not the point. But the point I want to walk away with perhaps is any positive takeaways from what the central bank governor did say earlier. Annabel, any positive announcements that perhaps we should also bring our attention to, aside from the fact that, I mean, if you do have a lot of debt right now, that debt is going to get a lot more expensive for you to service as a result of the hike?
Yes, that's the great concern. But anyway, look, I mean, I suppose a positive was the fact that we obviously saw the Reserve Bank looking for a 2% GDP growth rate this year. So it's not anticipating that its interest rate hikes are going to necessarily do immediate harm. But of course, next year, there's a strong downward revision of their growth forecasts. And that's, I think to 1.5% and 1.3% for the next couple of years, from figures closer to 2%. So I suppose that is, gravely concerning. And, if you wanted to look for a positive and you feel that, stringent inflation targeting is obviously necessary in the way to go for South Africa, then you would obviously be looking at the move, the 75 basis points being very positive. Of course, the financial markets would like it because it was above what was factored in. And that, of course, has resulted in the rand strengthening. And with the oil price coming off recently, we obviously have seen, a bit of currency weakness preventing a larger petrol price cut than we potentially could have had in August. So in August, that we are currently looking to see a significant petrol price cut. That's what's building. And if we see the rand strengthen between now and then the positive is that it would be an even larger petrol price cut. So I suppose if we are looking for a positive, ignoring the rate hike, then that certainly is one. I think lastly, though, global financial markets will see a sign of stability that South Africa is following the general trend with higher interest rates. And of course, that in itself is something which, would be seen to certainly aid the investment climate. If you have a look at our interest rates, our longer term interest rates in our bonds, quite high rates. But I would say that, there's also quite a big risk aversion sentiment globally. I don't necessarily think it's going to, on its own, be hugely attractive to foreign investment, because obviously there is concern that high interest rates would detract from economic growth. And I think, the point here is that South Africa's interest rates aren't high enough to be at the top tier of those offered globally, but they're not low enough to stimulate economic growth either. So we're sitting in the middle, and we really neither fish nor flesh. And as a consequence, we're actually finding the currency has seen substantial weakness, even though we've raised rates. So what I'm really saying is countries that have actually seen to have low interest rates, or even, cutting them and keeping them at lows, have actually gained. And here we're talking about emerging market currencies, against the basket of peers in recent weeks. And of course, ones that have hiked their interest rates, but not at the extreme upper end, offering, the top level of returns, haven't been that much in favor either. So, that is something perhaps to consider. That is, our interest rate hike on its own is not necessarily enough to cause the rand to strengthen very substantially. And I don't think it will, back towards 14 this quarter, or potentially even next quarter. And I think, that's where we're sitting at the moment, almost in a no man's land.
Sure. I think it's something the SARB should consider. But Prof. Bond, I know this is going to be really difficult for you, but one key positive takeaway from the announcement from the SARB.
Correction, then I'll give you a good positive. That is that I think we are actually at the highest tier. Annabel, I think if you look at say, The Economist, you find only 3 countries in our sort of peer group, which would be first Turkey, second Pakistan, third Brazil, actually have higher 10-year bond interest rate prices than we do. And I think we're already at that top tier, and we're squeezing too much. And I think the positive that comes out of this, if we do get dramatic instability, that would be a negative. President Ramaphosa may have to, as he did a year ago, toss out 350 rand a month again and do something on the fiscal side. But the positive, actually, I think, you may not like it, Annabel and Patrick, but since you said it so clearly, Annabel, this is really the banks winning today. So the creditors versus the debtors all over the world. Creditors are winning, but that actually positively will unite the critics. I think we've had so many divisions, the trade unions divided, social movements, the political parties are in fragmentation and chaos. I think this may have, we'll look back at it, a unifying effect. And that is a positive, because we need debtors to unite, because there's just too much at stake to let the bankers, control so much of the economy, including what we pay for interest at a time when inflation is imported, when we have such low investment levels. If you want foreign direct investment, well, I'd say let's have lower interest rates. If you want foreign portfolio investment, bankers sending money to get high interest rates, yes, you'll get that. But this is a sort of, let me call it, parasitical economy that I'm hoping will find more unity in the society to work against.